Good morning, good afternoon, and good evening, depending on where you're currently sitting around the world. It's my great pleasure to welcome you to this two-day New Economy Forum at the 2021 IMF World Bank annual meetings. After largely virtual meetings, we're reminded of how technology is helping us meet the challenges of a new economy. This forum comprises a series of interactive panels and workshops to discuss opportunities and challenges emerging from new financial technologies. The emphasis is very much on engaging with and learning from policy and private sector practitioners. Today's deliberations will focus on macro-financial implications of digital assets, on capital flows, and on the international monetary system. Then tomorrow, we will focus on how governments can leverage new technologies, or so-called GovTech. The focus of the first sessions will be on capital flow management measures, that is, measures used by many emerging and developing economies to limit capital flows. Such measures, or CFMs for short, are part of what we call the Integrated Policy Framework here at the IMF. CFMs are appropriate under certain circumstances, but will they be circumvented by new forms of digital payments? Many countries are especially concerned. Crypto assets, for one, allow users to hide their identity and facilitate transactions outside the traditional financial system. Exactly those intermediaries that today are essential to implement capital flow management measures. So how will CFMs have to change to remain effective? Can nascent crypto asset regulation intended to mitigate anti-money laundering and terrorist financing risks be leveraged to also enforce CFMs more effectively? Widespread access to foreign central bank digital currencies, or CBDCs, could also undermine countries' efforts to manage capital flows. So could CBDCs be designed differently, or does the solution lie in regulating the exchanges allowing for cross-border transactions? We hope to gain insights from today's participants. The second session will investigate related questions of an even broader nature, the impact of CBDCs on the international monetary and financial system. This is a topic of great interest to the IMF's membership. In addition to domestic benefits, CBDCs could also help make cross-border payments cheaper, faster, and more accessible. At the same time, widespread availability of a foreign CBDC could raise pressures on currency substitution, undermining monetary policy control, and could worsen vulnerabilities from currency mismatches. In addition, while access to foreign assets and market integration could benefit, capital flow volatility could increase, and arguably, gross foreign asset positions could grow, potentially stoking global imbalances. But by how much and through which channels? For that, we'll also ask our panelists. Relatedly, we'll also explore the question of whether CBDCs could lead to a reconfiguration of international currencies, and whether there really is a first mover advantage to gaining international adoption. Importantly, we'll ask whether the interoperability of digital forms of money could facilitate a multipolar international monetary and financial system. And finally, whether the global financial safety net itself will have to evolve. None of these are easy questions, but they are essential to economic and financial stability. Now, looking to tomorrow's sessions, technology has emerged as a vital ally for fighting corruption and enhancing governance, transparency, and accountability. We have seen efficiency gains in the public financial management and revenue administration, and in financial intelligence in the fight against money laundering and terrorist financing. We look forward to hearing lessons firsthand from participants on the role played by technology, big data, machine learning, blockchain, and other things. These new solutions can have macroeconomic benefits. In recent years, many countries have lost access to correspondent banking because of concerns with anti-money laundering and terrorist financing. So solving these issues can restore access to cross-border payments. We will also hear the experience of Pacific Island countries regarding their own innovative solutions in this area. But we will also bring the conversation down to regular citizens, the men and women on the street. How can digital innovations improve the services, such as transfer payments, during the recent pandemic? We're in for an incredibly insightful and productive 2 days. And for that, I really want to extend my warm thanks to all of you, both public and private sector representatives, for participating in this forum to share your perspective and experiences. We look forward to learning, debating, and exchanging. These interactions are crucial to develop, evolve, and strengthen policies, even more so given the phenomenal pace of digital transformation. I wish you all fruitful discussions and thank you for having me here this morning.
Welcome to this panel discussion on capital flow measures in the digital era. My name is Tobias Adrian. I'm the Financial Counselor and Director of the Monetary and Capital Markets Department of the International Monetary Fund. We have right now three panelists that are going to discuss the issue of capital flow measures in the digital era. The first participant is Mr. Dave Jevons. He is the founder and CEO of CipherTrace, a leading cryptocurrency intelligence company. He's a serial entrepreneur in crypto security, blockchain analytics, and fintech, and holds 26 patents. As an industry expert on blockchain security, internet fraud, and cybersecurity, he has advised Congress on these topics and is frequently quoted in the media. Our second panelist is Elia Matsibuko. He is the head of Financial Surveillance Department in the South African Reserve Bank. He is responsible for compliance with exchange control regulation and the application of the exchange control system in South Africa. He is a member of the Financial Stability Committee in the bank and an associate member of the Institute of Bankers in South Africa. Our third panelist is Dr. Vachira Aromdi. She is the Deputy Governor for Corporate Development in the Bank of Thailand. She oversees holistic organizational management of the bank and serves as chairman of the Banknote Management Committee. She is member of the Monetary Policy Committee and of the Payments Committee. Welcome all this morning. We are very excited to have you in this conversation. So let's start our discussion, and I'm going to turn to Dave first. The cryptocurrency industry is growing at a phenomenal pace, and adoption of cryptos is high in emerging markets and frontier economies. What do you see as the major driver of crypto adoption in emerging markets? To what extent is the adoption driven by avoidance of exchange and capital controls, and how important of a factor is that?
Tobias, thank you for your excellent question. The comments I'm going to give are my own. CipherTrace is a company, as you may know, is undergoing a merger with MasterCard. So these are my comments and not on the company side of things. But I would say that a large part of it is involved with capital controls and international funds transfers. So the fact is that you can transfer money through cryptocurrencies much more quickly, much more efficiently, with much more traceability and lower fees than you can with traditional banking payment systems. And that is a large part of why people are adopting cryptocurrencies. Certainly there's an aspect of speculation around it, for sure. And there's also, I think, investment opportunities in the space. There's a lot of new lending and capabilities and ways to provide lending through cryptocurrency. So that's an amazing development that is underappreciated in the market. But I would say, yeah, being able to move money more quickly around the world is a big driver.
Thank you, Dave. That's very clear. And let me turn to Dr. Aromdi. Capital flows associated with the rise of digital money bring into even sharper focus the policy trilemma, that is the trilemma between free capital flows, exchange rate flexibility, and monetary policy autonomy, which emerging markets are facing. How do you see countries' ability to enforce capital flow measures, if they choose to do so, being affected by the rise of crypto assets and digital money?
Thank you for the question. First of all, let me, I also agree with that the starting point of the crypto, I would like to say the crypto asset is starting from the pain point of the cost of fund transfer, but later on, the people, quite a lot of people are like you have mentioned. Later on, people are looking at it as an investment, so I call it as a crypto asset. But for the central bank, what is the implication of the digital money? Let me start from this, that we are in the world of changing financial landscape, and technology is one thing that technology is one factor that make payment more efficient, both in terms of time and in terms of cost. And this, as the speaker has mentioned, this will help people move money or transfer money, especially cross-border, more easier. Looking at the trilemma that you mentioned about capital flow, exchange rate flexibility, and monetary policy on the perspective of central bank, since digital money is into quite a lot of form, let's focus just only on some digital money, for example, stablecoin or some crypto asset that do not have any. Stablecoin is one thing that have something that is back, and then we try to make it less volatile, but still in some form of stablecoin you have algorithmic. So it seems like if people are moving and then using this kind of digital currency, so it seems that will have some implication on sovereignty or monetary policy, because if people are moving towards instead of using their own currency and then moving to the private digital currency, that will have some implication. And going back for the digital currency or digital money that you mentioned on the capital flow, since on the crypto asset, that will allow people to transfer money P2P easier. In the I use the word old-fashioned. In the old-fashioned, when we do the transfer, we have to go to banks, and then bank has to have some corresponding bank, and then that's why it's take times and then it costs money. And also some people cannot access to bank also. So that's why this kind of digital money make it more easier for people to do fund transfer. Of course, if it's P2P, people to people transfer money, it will not have much implication on capital flow. But if it be adopted massively, I think that's one will have some implication, especially in a country like Thailand, which is a small open economy, and then our is integrated to the world economy also. Capital flow, I have to use the word capital flow, not management. Capital flow monitoring to understand the capital flow is quite important, because it will have some implication on exchange rate also. So, in summarize, on the digital money, they have some implication on capital flow, and if the adoption rate is massive, it will have some impact on exchange volatility also, and then some monetary sovereignty also. Let me explain a little bit more on the CBDC, central bank digital currency. If we are talking about wholesale CBDC, so it's mean fund transfer between banks to banks, and even on the cross-border. On the central bank side, that one will enhance efficiency of the payment system. So that might not have an implication on capital flow or on the exchange rate volatility. But on the retail one, when retail CBDC, that people can do P2P and then fund transfer, that one will have some implication on the capital flow. That is the direct implication on the capital flow. But I think during this period, the adoption in the adoption rate is still at the beginning, so it will not have much impact. But indirectly, they have some implication because people are now thinking as a digital sum of digital money as I mentioned as a crypto asset. So they are looking at it as an opportunity and investment. So that have some implication also on capital flow. Thank you.
Thank you so much. Thank you so much, Deputy Governor Vatira. That is a very interesting perspective. And let me turn back to Elia Matsibo and ask, the same question that I'd asked to the Deputy Governor from Thailand. So to what extent do you see that these digital assets are undermining capital controls, and to what extent is the country's ability to enforce CFMs undermined in this new digital era?
Thank you. I would like to answer this question on the South African perspective. In your opening remarks, you alluded to a number of countries having capital controls. Now, South Africa traditionally has got exchange controls. So in a current environment, there are limits that are applicable to individuals and to corporates in terms of the transfer of money outside of the country. It's only now in South Africa that we have embarked in collaboration with the IMF and also with the OECD to the reform agenda, where we have since 1994 we have adopted to liberalize exchange control, on a gradual basis. So this process was ongoing, and 2 years ago, the Minister of Finance announced a move from capital controls to capital flow management measures, which we are busy establishing and implementing, where we are looking at opening up everything that could flow, but looking at more higher risky transactions that will still require approval by the banks and the central banks. Now, the issue of crypto assets is part of the innovation that, we never anticipated that it would lead to the illegal cross-border flows, because the main thing for us, and that is a risk for us, is that people now can be able to bypass the system where through fiat currency, we can monitor, because every individual in South Africa that actually embarks on a foreign exchange transaction to a bank, that transaction is reported and monitored. Even a company, when it does the FDI, that transaction is monitored and is reported. So all these banks and companies that want to take money out of the country, they need to work out of the banking system, where they've got what is called a forex license, and also they must have a reporting system that for every settlement for a forex transaction, that must be reported to the central bank. Now, with the crypto assets, so I alluded to the limits that are in South Africa, that somebody, I didn't do the conversion in dollars, unfortunately. Somebody in South Africa, as an individual, we are allowed to take for trade-related transaction about 1 billion rand. You can, in your head, convert that to dollars. I didn't convert that to dollars, unfortunately. And then we've got what we also call a foreign capital allowance, which is about, it's not 1 billion, it's 1 million rand. And then we've got 10 million rand that you could take as a foreign capital allowance for investment. Now, with the advent of crypto assets, so what happened, people started actually going offshore to buy crypto assets and then bringing them offshore And then once they are onshore, they actually go through the arbitrage process, where normally when you buy a crypto assets offshore and bring it back to South Africa, it goes through the price arbitrage process where it will gain 4%. And then they sell it for rand. They sell it for rand, and then they hold the crypto assets. Now, the problem with crypto service providers, or you can say crypto trading platforms, are not regulated as yet, as the banks are alluded to the banks. They are not licensed to trade in this type of financial products. So they can do as they like. No one is not within the remit or the purview of the regulators. So whatever happened in that space, we cannot monitor as South Africa. So once people have actually brought money back into South Africa and sold the crypto in rand in South Africa, now they are holding a crypto which is not being monitored by the central bank, and then they can take it out of the country without any knowledge whatsoever. And that is how now a number of illicit financial flows are taking place out of South Africa. So when it comes to the regulations, we had opted to decide whether to actually ban people engaging in cryptos, or to adopt a wait and see attitude and just watch, innovation to develop itself, or maybe to develop a regulatory environment for this type of financial product, of which we are busy involved in that at the moment. And I think the key driver, we talk about monetary policy in terms of, but one of the international bodies that was very much concerned with the development of crypto assets and its impact was the Financial Action Task Force, because of its impact on terrorist financing and money laundering. I think the issues of monetary policy, those could wait because the risks are not very high. That's part of the innovation, to say, how are you going to implement monetary policy through the crypto asset mechanism. So that is where the challenge that the world is facing. But I think we are forced in South Africa now as the central bank to move very quickly to regulate, but it involves now the financial center intelligence unit in South Africa, that they should start to monitor and identify crypto assets trading platforms, and they must be registered and licensed, and also crypto asset service providers, because those are the people that are involved in conduct, where the financial sector conduct authority needs to be involved, so that people are not cheated out of their money, and they provide a tangible and integrity service to the consumers. So we are in that process. It's quite a lengthy and a very slow process that we have undertaken, because it requires a number of laws that needs to be changed. First, as I said, South Africa has got exchange control regulations. You will need to change that so that you can regard crypto assets as part of capital, because exchange control prohibit the movement of capital out of the country. But currently, we don't regard crypto assets as part of capital. And then from there, as part of the Financial Regulatory Sector Act, where it's an overarching bill where it regulates financial services, financial instruments, and financial product. That act in itself will need to be changed. And I think, the move here, what will happen is that, because of the pressure that we are getting from the Financial Action Task Force, we will move faster to make a financial intelligence center unit to try and start to register these the providers of crypto assets, because they will need to know your customer. Is the requirement to provide due diligence, custom information, and verification activities involved, and transaction. And that is where the data is, I think, is going to come first, even before it comes for the central banks. So it's a big challenge for us in terms of the illicit financial flows. We are moving, but innovation always exposes the gaps in the existing legislation, because innovation is ahead of old legislation, and we need to plug those gaps to see how we can actually bring the regulation of crypto assets within the remit of the regulatory space. Thank you.
Thank you so much, Elia. That was a very good exposition of the challenges that emerging market central banks are facing. So let me turn back to Dave Jevons and ask about these technological developments in the crypto industry, which are very fast and which are improving settlement cycles. So in particular, I wanted to focus in on the tokenization of bank deposits and tokenization of other financial assets as well. Could the changing configuration of global capital markets be impacted by these developments? And what's your opinion on the rise of crypto assets in digital money in terms of capital flow impacts? I would also like to give you the opportunity to react to what you heard from the Bank of Thailand and the South African Reserve Bank. Dave.
Thank you, Tobias. So my response on this is I just spent the last hour prior to this meeting with FATF. I've been working with Financial Action Task Force for almost 2 years, maybe 2.5 years, on the virtual asset contact working group. So that is, I would recommend everybody in the central banking space to look at all of the documents that FATF is providing, to participate on the virtual asset contact working group, which is meeting today. There are quite a lot of technical capabilities, red flag documents that are available. I would also recommend everyone to take a look at the FinCEN red flag documents, as well as the FATF ones, to get an understanding of how you might want to craft your policy. I feel that they're well thought out. There's been a lot of debate and a lot of discussion over the last 2 years with both banks, regulators, and the technology industry, as well as the cryptocurrency industry. So that's my response on the comments that I heard today, which I thought were very well thought out. So thank you everybody for providing those. On the other side of things, we're going to see a lot of change in the industry here. So when we think about how it impacts the bigger markets, monitoring, et cetera. So monitoring is available. Those products exist. They can be implemented. What we have to think about are CBDCs and how they will interact with what's going on in the stablecoin market. So if we look at the stablecoin market, that is largely a settlement mechanism, and that is where you're going to see the large amounts of capital flowing. And that is something to really keep an eye on. I also think when you look at how certain countries are developing CBDCs, they have different reasons for doing it, but that can impact the world on a very big side of things, because they will bring in their counterparties, other countries, into those systems. And that will have an impact on monetary policy, funds flow, but also privacy and tracking, not only of everything that's out there, but also consumer transactions. So this is an area that I think every government, every regulator needs to be thinking about. There is a potential dramatic shift of financial power coming, and it's going to be based around crypto and stable coins and CBDCs. And we all know which countries are building them and which ones aren't.
Thanks, Dave. That's a tremendously useful comment, that CBDCs, the emergence of CBDCs and the stable coins have to be interoperable in some ways, and they are going to change the global financial landscape. So let me dig a little bit deeper in this area. So is there something that central banks can do, either in the design of CBDCs or in the regulation of stablecoins, to get a better grip around these capital flow issues. As you're mentioning, some countries are very much forward-leaning in this space. Other countries are catching up. But in particular for emerging markets where the capital flow issues are very much first order, do you see something that can be done to design CBDCs or regulate stablecoins in a way that can improve this space? Of course, RegTech and SupTech is also related to these questions.
Certainly. So the first thing is adoption of standards around what is a cryptocurrency. Is it a currency? Is it an asset? Very simple. You have to decide, but make a decision. And then having regulation of cryptocurrency exchanges in your country, or at least registration, not that hard to do, absolutely needs to be done. So this gives you like a broad footprint of control around monitoring who's in, who's out. Employ RegTech, SupTech technologies from our company or others. Get that technology in place. Again, not that hard. There's a lot of companies who will help you do that. So that's, I would say that's the first. Now in CBDCs, my view on this is everyone's going to have to do one or adopt one. I would suggest that the right way to do it is enroll your major banks in your country to be the issuers of that currency, to do the AML controls, to do the identity controls, to understand KYC, and also to operate part of the network, because that makes the network much more secure. So if you hack the central bank, you don't control the currency of the entire country. You have to hack 51% of all the banks plus the central bank to control the currency. So it gives you security benefits, privacy benefits, and also leverages the existing infrastructure of, for example, card issuance, bank issuance, etc.
That's a very useful comment. And of course, here at the IMF, we have been thinking about synthetic central bank digital currency, which would be something very close to a digital currency of the central bank, but it would be operated by commercial banks. And the regulation of stable coins is very closely linked to that issue. So thanks, Dave, for flagging that in particular. So let me turn back to Deputy Governor Vichara Aromdi. The Bank of Thailand has been very active in terms of doing experiments both for wholesale and for retail CBDCs. So how is the Bank of Thailand taking into account the need to manage capital flows when you're thinking about CBDC, either on the wholesale or the retail side? And is RegTech and SupTech helping you in that endeavor?
First of all, I feel more comfortable when Dave mentioned about that. For the crypto asset or cryptocurrency, you the technology, you can have some technology that you can monitor them. So I think that is quite make central bank feel more comfortable, because as Elijah has mentioned, at the Bank of Thailand also we face similar issue like South African central bank. We allow, but in our case, we allow do crypto asset trading. We have crypto asset trading in Thailand, but we still are not allow people to bring the money and then invest in crypto asset abroad. But it's quite difficult. In fact, when we have this, but it's quite difficult because people are still trying finding some ways to go out, because they can invest in some foreign asset abroad, and then they can exchange and then transfer it, exchange it, and then they can finally investing in crypto asset abroad. So this one is not working well, but since we admitted at the beginning that this is the beginning, and then we try to understand it more. And I think that it has some implication, not just only capital flow, but a lot of implication, especially when I'm talking about the stablecoin. Then some stablecoin first issue, and then some private sector would like to bring to Thailand, or some of the private sector, even in Thailand, would like to issue some stablecoin. We work closely with them, and then try to not discourage them, not to really issue that kind of stablecoin yet, because as I mentioned earlier, we do not really understand it. And if some stablecoin, if it's algorithmic things, it means that they can do whatever, and then the issuer will act like a central bank. So what will be the implication? That's why we try to discourage. And then during that time, I think 3 to 4 years ago, we start looking at this kind of technology. We know that this kind of technology has some benefit, and then it will help enhancing efficiency of quite a lot of things. That's why we start doing the wholesale CBDC first. When we are talking about CBDC, people are worried, are concerned about monetary stability, financial landscape, and also financial stability. So that's why at the beginning we start with the wholesale CBDC. So we try to replicate the payment system, and then we invite all banks, not all banks, but 8 commercial banks in Thailand to join us. And then we think that this is a part that we prepare ourselves, both central bank and Thai financial community, to at least familiar with this kind of technology. So we do a pilot test on the wholesale CBDC, and then we pair with other central bank, Hong Kong Monetary Authority, try to do the cross-border payment. That one, when we do the cross-border thing, during that time we said that, okay, we are going to do the pilot and then focus on the technology things, and then to see how will it work out. It can work quite well, but after finish that phase, we are and then we coming back, and then we said that now we have to think about the policy issue. We have to think about what will be the implication on the capital flow, what will be the implication on the monitoring, apart from the data or from other things. But if we can control, or if each central bank still I'm sorry, I should not use the word control. If we can monitor it, and then we can understand what's happened, I think that's okay. And then since the pilot is just 2 countries, so the Bank of Thailand and HKMA, you can see the flow, and then we try to replicate the traditional cross-border, especially on the trade settlement. So it works quite well. But now we are in the stage of cooperate with another 2 central banks, PBC and UAE, try to see how will it work well with the cross-border payment, with not just only 2, now 4 country, and then 4 currency, and then we have a BIS also as a coordinator. Meanwhile, doing that, with the rise of the private sector stablecoin coming out, we are also focusing on retail CBDC also. This one, as I mentioned, if it access to retail, it means that people can have their own wallets, and then can transfer P2P. So the implication on the capital flow, if it's P2P, if we limit the size, the amount of the people who money that people can hold in their wallet, so at least we can monitor, and then we can understand them. But we are in the very first stage of doing the proof of concept, and then hopefully that next year we can launch a pilot project and see how it works. But we will start just only in the domestic first, and then we'll do what's happened. Then I think this one it's going to be a long term, a long journey for us, and then we'll see. This will have depends also on the adoption and also on the behavior of not just only customer but also the behavior of service provider also. The interaction between them will change also. That will have another implication on other thing else. But if only on the cross border, we still focus on the limit of the size. I hope that will work out well. Thank you.
Thank you. Thank you very much, Governor RMD. So let me turn back to Elia Mazibuko from the Reserve Bank of South Africa and ask about the cross-border aspects of digital money. Those clearly have implications for capital flows. And so my question is, what can be done to enhance collaboration among countries, to enhance collaboration among regulators and central banks on crypto assets and CBDCs? In particular, what kind of data gaps can be closed through international cooperation and by working across countries?
Thank you. I just want to mention something that, with regard to the CBDC, there was a recent survey by the Bank of International Settlements where, recently 86% of the central banks are actively researching the potential for CBDCs. 60% were experimenting with the technology. We heard about SUPTEC and RegTech, and then 14% were deploying pilot projects. Now, this is very interesting because it can actually cause a collaboration among central banks by sharing that information. But I just want to mention that South Africa is part of a project called, I don't know whether you have heard about it, it's called Project Danba, which is under the auspices of the Bank of International Settlement. And Project Danba, will test the use of central bank digital currencies with Australia, Malaysia, Singapore, and South Africa in an experiment that could lead to a more efficient global payment platform. What is interesting, given the participation in the Project Danba, is that there's some form of emerging convergence towards a common approach in exploring the potential benefit of a shared multilateral and multi-currency CBDC in a natural next step on the broader CBDC journey. And from that perspective, we are excited to be involved in Project Danba. And also it will help us because South Africa in the past few years created what was called the SADC, South African Development Community Regional Retail Settlement, which is a settlement that was meant for trade to facilitate the speedily payment of trade-related transactions. Now, those transactions are normally settled in rand, because the rand is quite a common currency for the emerging markets, especially in Africa. But we are exploring now with this Project Danba to say, can't we change from the settlement of the current money and push it towards the CBDC? And I think it will reduce cost and the settlement will be quite quicker. So the problem of data gaps, of course, will exist because with monetary policy, for the monetary policy to exist, banks are given the mandate for profitability and they need to gather information on economic growth, and that information is easily available for them in order to make decision maybe on inflation. Now, once crypto assets, come into the fore, and there will need to be the availability of that information on the economic activity, because the risk if we let crypto assets create a payment parallel system and the one is not monitored, that is where the data gap is going to exist. Because even for us now, as I alluded to earlier, that with exchange controls, every transaction foreign exchange transactions in South Africa, as reported, we are able to monitor and do surveillance on these transactions. And so now what is very important is that even towards the other areas of central banking like financial stability, because that is where the concern with crypto assets to say whether in future financial institutions would have exposure to crypto assets, which might lead to financial stability issues. Although as I said, currently doesn't appear that there's a huge exposure and interest from central banks, because I think they are very much conservative in nature to try to be exposed to this. And I think the global financial crisis of 2007 still linger in the minds of a number of financial institutions that were, especially those that were in existence at that particular time. So it will be quite important that, as I alluded to the project then, but to say for central banks to be able to cooperate, collaborate, but then in future to be able to share information on CBDC, because of the interconnectedness of the global market. And this is what we saw in 2007, that what happens in another country could have an impact in another jurisdiction. So that is very much important. As I said, people should not work in silos in this regard, but there must be sharing of expertise and sharing of information, and also the challenges that are faced. While maybe you might confine the crypto assets to the environment, to the jurisdiction and domestic needs, but I think most of the faces and characteristics of the CBDC will be similar around the world. Thank you.
Thank you very much, Elia. And I'm happy to report that our fourth panelist was able to join us, Ms. Caitlin Long. Caitlin is the founder and CEO of Avanti Bank and Trust, a Wyoming chartered bank that provides digital asset services. She has 22 years of professional experience in Wall Street, and she became involved with Bitcoin in 2012. And was appointed to serve on the Wyoming Legislature Blockchain Task Force, which has a big impact at the moment in the United States in particular. So, Caitlin, let me turn to you with a question. Cryptocurrencies still lack harmonized definitions and taxonomies depending on the regulatory purposes. Do you think the fragmented approach to crypto asset regulation across the world is a risk to global financial stability? And secondly, how should the design of crypto regulation in the US take into account its potential impact globally, in particular on emerging markets and developing economies?
Thank you, and it's a pleasure to be here. I apologize for the mix-up to you and to my co-panelists. As to the taxonomy question, yes, that is an important distinction, and this is where the global authorities can help to harmonize the definitions across the different government jurisdictions. One of the challenges, of course, with digital assets is that they do not respect national borders, and they do not, therefore, respect national laws. In the intermediaries who use them, of course, do, but the individuals may not. And certainly the technology protocols do not. And so that is a challenge. And what's interesting, if we go back to Wyoming's work, which led so far within the United States, Wyoming was the first state to create a taxonomy. Wyoming actually essentially copied Switzerland's taxonomy. So when you did have a government that led in this area, it actually created a regime for others to copy. And we're seeing that within the United States, but of course, the United States is 50 United States plus the federal government, and getting alignment even within the United States is a challenge, much less getting alignment outside of the United States. One of the biggest challenges with the taxonomy that I would note is the different definition of securities. In a lot of the G20 countries, the definition of investment contract is not considered security. And therefore, it's not as broad. The definition of security is as broad. But in the United States, in the Howey test, the concept of an investment contract is in the definition of security. And that is a problem with the securities markets, even outside of cryptocurrencies, that you have the different definitions that do not conform across the world, because so many more things are securities in the United States than outside the United States, because there is that catch-all investment contract. In fact, a lot of bank products, there was a lot of litigation in the United States in the 1970s over whether money market products and even certificates of deposit, very common bank products in the latter case, were caught in that investment contract definition. So the problem is in the U.S. in that regard, because it's overly broad. And in terms of working with the world, I would think through bodies like this. This is where we have the opportunity to create alignment. We will never have 100% perfect alignment, as you know. Those protocols are code-based. They're not legal-based. I say software code. Software code is just the language of a different operating system than legal code. Legal code uses words. Software code uses software languages, but they each are separate operating systems. And one of the most important aspects of bringing this technology into the legal system is making the two compatible. And that is indeed what we strive to do in the state of Wyoming, which has been copied by several other states within the United States, even some countries now outside.
Thank you. That's very clear. And let me follow up with a related question to Caitlin. So, of course, you're at the forefront of developing banks with tokenized liabilities, and as a bank, of course, there's a tight frame around digital identity, AML, CFT, and integrity issues. And so that has implications for capital flows across borders. So the discussion until now really was about the challenges of regulators and central banks to control capital, given that crypto assets can flow very easily across borders. But am I right to think that with tokenized bank deposits, there's quite a bit of hope, because you're in the regular banking regulatory frameworks, rules by FATF and integrity rules apply, and so you're not really facing those same challenges with tokenized bank liabilities as the ones that you're facing with crypto assets. Caitlin.
Yes, that's right. The banks, of course, are subject to, in the United States, the Bank Secrecy Act and all related rules and regulations which conform with FATF and, of course, the travel rule. It turns out that all of the intermediaries in the United States that handle crypto assets are subject to the same rules. There's no difference between banks and non-banks. The difference does, though, come into play in how often those entities are examined. So there is a group called FinCEN, Financial Crimes Enforcement Network, that is a federal government agency, part of, I believe, the U.S. Treasury. And FinCEN released rules for virtual asset service providers that are consistent with the FATF rules that apply to all intermediaries. So really the only part of the industry that does not capture the identity information and comply with the travel rule is those that serve individual to individual, peer to peer. But anything that touches a bank, which of course any intermediary most likely does, obviously goes through bank level supervision. And you have that second layer of supervision through the bank supervisors, but also the money transmitters are supposed to be examined. They're not always. In fact, I in a comment letter that my company Avanti submitted to the Federal Reserve on its payment system access policies, I noted the details of how the different intermediaries in this industry are examined, and it turns out some of the largest ones have not been examined ever. So that does open the question whether they are complying to the same level as a bank would with those standards. But it is true that the same standards apply across the board.
Thanks, Caitlin. Yeah, that's very clear, and it's a little hope here for central banks to really get on top of the capital flow issues to the extent that crypto liabilities are issued by the banks. It should be much easier. Let me go to the final set of questions, and I just wanted to turn back to Dave. Dave, one of the things you said was that emerging markets should collect identities at the wallet level, but of course there are the peer-to-peer transactions which are not necessarily done through the wallets. Any thoughts around how you get a grip on that particular challenge? And that's actually something we've seen in some of the emerging markets that have cracked down on crypto assets. We've seen this emergence of peer-to-peer transactions, and Caitlin also mentioned that just now. So that's and then any wrap up thoughts, Dave?
Sure. Thank you, Tobias. So I think on the P2P side of things, at the end of the day, everything right now is cleared through a commercial bank, through customer bank accounts, whether they're corporate or in many cases just consumer bank accounts. That's where KYC is done. I think Caitlin's comments are well taken. The issue is not more regulation. The issue is enforcement. And in my view, there are so many countries, particularly in emerging markets, that do not provide registration. They do not require it. They do not enforce. This is where we're seeing most of the criminal activity and capital outflows going to and from. So I think that's a first thing, is trying to get some harmonization around enforcement through the central banks throughout the world, and particularly in emerging markets.
Yeah.
And then I guess I would just close with once we get that done. I don't think that there's a lot of more that needs to be done in regulatory thing. We need to implement. So as Caitlin talked about, travel rule is a thing. We've been working on it at CipherTrace for several years, and we've set up a nonprofit in this area to build standards across the world and bridge the gaps between what's happening in Switzerland, what's happening in Singapore, what's happening in the United States. That effort needs to continue. So it's, we're still a long way from it, but we'll get there. I'm seeing very positive things, but again, I would just stress getting more central banks and regulators in particular to start to understand a more homogeneous regime and classification, and then enforcement on their exchanges. I believe that will help us a lot. Now, there is a second question that you asked about identity, and that would apply to DeFi and other types of systems. I would say that's in flux right now, so I would look to the FATF around that, as well as FinCEN, to think about how countries want to implement, for example, identity policies around non-hosted wallets and the participation in DeFi protocols, large money transfers, reporting, SARs, CTRs, currency transaction reporting, etc. So that right now is unregulated in crypto. Lots of it is regulated, but some of those things are not, and certainly we're not homogenous around the world. So if those are things we can all come to grips on with the next 12 months or so, that would help, I think, the industry to grow. And I'll leave you with a last point. if every bad guy used cryptocurrencies, the world will be a much safer place because we have a ton of traceability capability. We can look through multiple transaction histories. We don't have to rely on only banks reporting to each other. We don't have to deal with central solvers and all the other things. So if we can make this technology pervasive, we will have a more free society, but we will also have the ability to shut down criminals.
Thank you, Dave. Those are good words to end on this panel. We are out of time. It's a topic that we could discuss all day. And let me just finish by reminding us all of our basic approach in this space to policies. There are a lot of opportunities and there are risks. And the good policy framework balances the opportunities and the risks in an appropriate manner. I think the panel today gave us a lot of insight as to the direction of travel, as to where we should be going globally, as well as in each country. So let me thank the four panelists, Dave Javins, Caitlin Long, Bachira Aromdi, and Elia Matsibuko for a fascinating discussion. Have a wonderful day or evening, depending on where you are. Bye-bye.